So in this part of the video, we will be talking about liquidity versus inducement. Now, what is liquidity? Well, liquidity is what facilitates the transaction between buyers and sellers, right? So what it means is that in one hand, when you have there will always be a buyer and there will always be a seller. So what facilitates the transaction between these two is liquidity, is when there is money around, right? So that is just on a basic term, right? That's just the basic notion behind what is liquidity. But on a technical perspective, right, in trading, liquidity is sitting at every high and low. So what it means is that, for example, if we look here at this schematic to the left, we have this low and we have this high. So what it means is that there were buyers here at this end waiting to buy, to push price to the upside. Then what happened? We had a pullback. So that means that there were sellers that put money here to drive price to the downside. But what happens is that because we have more buyers than sellers, that's why we will see the trend actually going up, right? So when we have a bullish structure, for example, we have a series of high highs and high lows, that means that we have more orders to buy than selling, right? Of course, price will pull back, but if we see price continue to the upside, that means that we have more buyers. So what it means is that at every high and low, there is money sitting right there. At this low, there were buyers right here. So when they push price up, there were still orders here. So what happens is that the sellers could just they can just put a large order to take out this low and then see the move continue towards the upside. So that would have been like just a liquidity grab, right? So this is just the various forms of liquidity. For example, that is just what liquidity is. Now, when it comes to inducement, the word inducement means making you do something. That's just the meaning of it, right? Entice you to do something. And that's what in trading we call traps, or some people call smart money traps or retail traps. It's the same thing as inducement, right? And what it means, for example, is let's say you have a trend line, right? We have this sort of trend line right here, and we see price bouncing multiple times, right, at this trend line. What normally people will do is say, okay, I'm seeing price actually tapping multiple times at this trend line. So that means that, and I'm seeing that whenever price taps here, price tends to go up. So what happens is that normally what you will do is actually set a limit order here when you see price actually coming towards the trend line, and you say, okay, I'm hoping to see price actually moving towards the upside. What happens is that sometimes you may be right, but sometimes price may just come grabbing all this liquidity, and then we have the move continue towards the upside, right? That's why in trading, we're never right 100%, right? It's just probabilities at the end of the day, right? So it's nothing to fear about. I mean, liquidity is nothing to fear about because we will always take losses, right? Sometimes we will once we put a limit order at that trend line, we will be right, sometimes not, right? So it's all about risk to reward ratio. So it's nothing to fear about. Now, it's very important to be aware, right, of when the liquidity is being engineered, so you can better protect yourself, right? So in this particular scenario, for example, this is the type of what we call retail concept liquidity, right? Because I mean, even if you're a smart money concept trader, you're still a retail trader. So this is just the retail concept liquidity, right? We can see that, okay, price actually broke structure, and then we have this support zone right here, and then we have this resistance zone right here, also in a form of trend line. So what happens is that a lot of people are waiting for the next step, right? Once price actually pushed up, once price came here, there were people with limit orders right here, right? What happens is that price, okay, will make them happy a little bit, then it comes back, takes them all out, right? So pretty much everybody that had orders sitting below right here, they got swept right here. Now, you have the smart money concepts trap here as well. If you look at it, this right here was a break of structure. Some people are looking at some sort of order block right here. What happens? Price then continues to push to the upside. because they came to this order block setting below. So if you're a smart money concept and you know, and you look at the trend, you say, okay, we're bullish actually. So we have this push towards the upside. We have an order block sitting below that left imbalances right here. We can say that, okay, we have a clean order block, huge imbalance, and price right here is just engineer liquidity, right? We see this consolidation. Then price pushes to the upside. There will be some people waiting, trying to buy after this break of structure right here. They got swept. So you can just say, okay, we have liquidity here. I have this order block. We have confluences. We have huge momentum. We have loads of imbalances sitting above the order block. So I think it's much more valid to take this extreme, and then we see the price continue to the upside. So right here, you would have been able to be on the right side of the market, right? But eventually, I mean, it's not just to say that you can avoid losing. I mean, it's impossible in trading. Eventually, it may not work, right? Sometimes you may think that price will react here. Sometimes price can just, once it comes here, price can just sweep a little bit the point of interest as long as it doesn't close below, and then it continues to the upside in this scenario. It's very common to happen as well, right? So the other type of liquidity is this one right here to the right. This is like what I will call a smart money concept, engineer liquidity, right? Or inducement, right? In this particular case, is that we have this structure high and then we have this low. What happened is that then we had this break of structure right here to the upside. Then price gives us, for example, a successful retrace, and then we have the second break of structure. Normally, what people will say is, okay, we have the second break of structure, we have an order block right here. I'm going to take this trade. Most of the times it may work, right? Sometimes price will react off the second and just continue to the upside. But sometimes it will actually use this low as inducement to entice so many traders, right? Because of the break of structure and the OB, they will entice traders to get in, take them all out, come to the extreme, and then move towards the upside. And the reason why in these scenarios I like to take the extreme is because this low actually was swept liquidity right here from this previous structure low. So right, so what happens is that price came down, grabbed liquidity from the previous low, and then went on to break structure. So this is what we call a strong low. It's bound to be mitigated most of the times, right? So right here we have the clean order block. We have a lot of imbalance and huge momentum. Those are just conferences as to why I would take the extreme. But not to say that sometimes I would have missed the trade, because sometimes price can just react here and move, right? Or sometimes it can also take me out, right? And just reverse, right? It's one of the reasons why this is not 100%. There is no 100% win rate, right? So right here at the extreme, we can see that price just used this low as inducement to come here, sweep, and then continue to move towards the upside, right? So this is just so many of the ways that they can just trap, create some sort of manipulation in the markets, and then continue to move towards the upside. But me personally, I don't like to see this as a manipulation to traders. I just like to see this as a mitigation, right, of an order block. Sometimes they may not want to react here. They want to push price lower, right, to buy lower and then sell higher. Right, so I would just see this move, them actually pushing price to this extreme point of interest as them actually wanting to buy something at a lower price, right? So they can actually make more profit. So you can take advantage of this. You wouldn't look at this as to be some sort of trap, right? So, for example, we have another schematic right here. If we look at what's going on right here, is that we had this previous low, high, and then low, right? Then price actually pushes towards the upside, and it starts to engineer this trend line liquidity right here, and then it breaks structure. What happens right here is that a lot of people are saying, okay, price broke structure. This was the last down candle before the up move that broke structure, so I'm taking this point of interest. But what you don't see is that we have this low that grabbed liquidity from this structure low right here, and he left, let's say he left huge imbalances below. It would be a little bit dangerous to buy from this one right here, right? So me personally, as I always like to take the extreme, I would have seen, okay, this conference, okay, we have a nice push towards the upside, huge momentum, imbalances. So there is a possibility the price may just use this as inducement, right? So you can see that we have liquidity engineered in the form of trend line, and we have inducement as a trap right here that for so many people that we're enticed to buy from this order block, right? So we have liquidity and inducement together right here. And then we have what? The trap, the manipulation, when they actually take everybody out, and then we have the expansion right there, right? This is just the various forms of liquidity. We have this one, which is actually a very powerful one, actually. And that's when you have, for example, this low, right? That, for example, took out this previous structure, substructure low. And then we see actually price actually, breaking this previous high, but price actually came back, I mean, pushed up, pulled back a little bit. It seemed like it tapped the point of interest, the order block, but it didn't, right? I mean, it may just tap a little bit and then push to the upside. What it will make you think is that, okay, this order block is mitigated, so I'm going to take this one right here, which was the decisional one. So what happens is that you buy here, price actually makes you happy a little bit, then it comes to the extreme, traps everybody, and then we see this move towards the upside. It's something very, very important, right? That's why it's very important to see when order block actually comes within the order block, right? That just makes it seem like it was really, really mitigated, right? So this is just a great form of inducement that is very, very common in smart money concepts, okay? So very important to take note of that. So let's just hop on the charts and look at one great example. So here we are, for example, this is the New Zealand dollar. So for example, we can just pick a great example right here that I'm seeing is that we had, for example, this break because we had this structure high, substructure high, low, and then price created this high, right? So what happened is that we had this break of structure right here, for example, right here. So what was responsible was this supply zone right here. We had this let's buy before the sell that wanted to take that low. But what happened is that, okay, this high was only broken right here, right? That's when we had the break of structure. So let me mark this as post up. So we had the break of structure. What happens, as we can see, is that we had this liquidity being engineered right here in form of, we can see that this was relative equal lows right here. So this was equal lows. This actually was great, right? Because price then, what happened is that it took everybody out. So all these people that were waiting for the triple top, the triple bottom, for example, they got swept right here, right? As soon as they had their orders here, they got swept, and then they saw price actually continue to push to the upside. But what happened actually is that we have this nice order block sitting below. We have imbalances left right here. So we still have loads of imbalances below, and we have a clean order block right here. That's why price actually came down, right? Trapped everybody right here. So some people will say, okay, this right here was the sweep, and then price went on to break structure. So I'm taking this point of interest right here. And guess what happened? When the price came, they got taken out as well. The smart money count. So retail traders got swept. Smart money traders also got swept right here, right? If they set their limit orders right here, and then price came to the extreme and continued to push to the upside. So this is just a lot of ways that price actually engineered liquidity. That's one of the reasons why I like to take confirmation entries. This is the M15. I would have gone to M1, then on the second. So it's just a way of trying to increase the strike rate, but at the end of the day, there is always that notion that there is no 100% win rate, right? So eventually we will become a liquidity. But in this scenario, it was great because we have this retail concept liquidity engineered. Then we have the sweep and then the break. And so many people would have taken this week. I think I would have also taken this week as my point of interest, but as far as I can see, there was no confirmation on the lower time frame, but price came to this extreme, grabbed all this liquidity right here. We can see that consider this to be like a trend line liquidity, right? It grabbed liquidity and then continued to push to the upside. Then usually when it grabs liquidity, the move is strong, right? That's why we can see price that just pushed all the way to the upside right there, right? So another great example that I would love to show you is this one right here, right? if we look at what's going on right here is that we have this push break of structure, we have this mitigation of this black candle, and then we have the second break of structure. So there is no imbalance here. There is nothing. Pretty much everything has been mitigated. So there is no reason for price to come down right here, right? There is nothing. Everything, the price action here is efficient. So then what happens is that price pulled back, right? And then went on to break structure. Now, the question is, where is the order block, right? We can see that we have this order block right here, and it had imbalance, but price then came down and it corrected the imbalance, but it didn't pretty much mitigate the order block. It was just a subtle tap, right, before the price actually pushed to the upside. When it comes to refinements, right, if I drop down, for example, to 10, let me just go to 10 minutes. Okay, let me just use the 10-minute. If we look at this order block right here, is that we have this wick right here, which is higher than the previous candle. This candle pretty much has no wicks, right? So what it means is that this was the last point of seller's exhaustion before the buyers came in and pushed up. So technically, this is an order block right here. So it wasn't mitigated. This right here was the inducement. We can see that price didn't even tap at this black candle right here, right? We can see that price actually failed to tap this black candle and then went on to break structure. So I'm pretty sure so many people, right? Let me just use this wick. This is the order block right here, right? This one. So I'm pretty sure so many people said, okay, we have this wick that swept the previous candle's wick, so I believe this is the order block because they think that price actually mitigated this candle, right? So what happens is that, for example, if you set your limit order right here, let's just set the limit order here. Stop loss below, let's just give like a 4 pip, yeah, 4 pip, a round number, right? So this would have been the order block that most people would have chosen, right? This one right here. So if we look at what happened then is price actually came perfectly right here, right? So you would have been tagged and you would have seen the blues, right? And you're waiting for price to break this high to go break even, right? So price then comes back, bounces again, and then takes you out right there. So we can clearly see that price actually came to this point of interest, right? Took everybody out, and then it moved all the way to the upside. So this was just a great inducement that was engineered right here. They knew that so many people would have bought from this point of interest. They made them happy a little bit. They were waiting for this price, this high to go break even, but price actually took them out, came to the extreme. And remember, when I talk, the reason why price came here to this week is because this was the last point of seller's exhaustion before buyers came in, pushed the candles up to break this previous high. So there was still resting orders right here. The order block was still unmitigated, and price just used this as inducement. And we can see that if I delete this order block, we can also see that we had this trend line liquidity built right here, right? This tap, the second tap, the third tap, then price swept and then went on to break structure. Okay, so this was just the way that they engineer liquidity, right? And to trap traders, right? And I mean, it's nothing to fear about, right? Because we all eventually become liquidity. Even the banks also become liquid. The banks also lose money, right? So it's all about risk to reward ratio. When it goes your way, you're able to make more money than you lose. But being able to have these conferences and this understanding of inducement will be able to help you avoid some of these traps, right? And so that's it for this video, guys. I hope I was able to get my point across in this one, and I'll see you on the next one.